Target reporting better than expected results for the fourth quarter. The retailer posting earnings of $1.89 a share. The street was only looking for $1.40 a share. Revenue beat, too. It came in at $31.4 billion versus the $30.7 billion the street was expecting. You can see that stock up by about 3.4% right now. Joining us to talk more about it is Brian Cornell. He's Target's chairman and CEO. And Brian, thanks for being here today.
Good to be here.
All right, let's talk about this because you beat by a big number on the fourth quarter, but for the guidance for the first quarter and the full year, it was a little below. But let's run through everything and kind of work out what's happening, because I think you're a very important tell of what's happening with the consumer.
Sure.
So what are you seeing?
Well, let me try to unpack both the quarter and the full year, and then we can talk about guidance. Okay. Certainly we saw really solid results in the fourth quarter. It was our 23rd consecutive quarter of comp store sales increases, and it was driven by traffic. So we continue to see really strong traffic gains across our business. And if you look at the full year, and you talked about it earlier today, during the pandemic, we added almost $30 billion of top-line growth. We had another $3 billion of growth in 2022. And it was driven once again by strong traffic increases. We grew unit share across all 5 of our key merchandising categories. So we continue to see a consumer who's shopping at Target. From a spending standpoint, they're leaning into food and beverage categories and household essentials and beauty. But I think one of the facts that may not be coming through in the report is while there has been some softness in discretionary categories, we delivered $55 billion of revenue through discretionary categories in 2022. So they're not going to zero, but we have seen a consumer who's not spending the way they were during the pandemic. But if I look at discretionary spending going back to 2019, we added almost $14 billion of discretionary growth over the last 3 years. So those categories are still active. We're still making sure we make the right choices, but we're going to manage inventory conservatively and lean into the spaces where we know consumers are spending today.
And inventory has been a big issue over the last several quarters. You've had to do a lot to clean things up. Right now, you're dealing with inventory that's down 3% in total. That discretionary inventory is down even more. What is it, down 13 to 14%?
It is. Well, one of the last times we were together, we were talking about inventory. I go back to the middle of 2022, and we realized consumer spending habits had changed. The way they were spending during the pandemic, buying TVs, spending dollars on their home, they were starting to curtail that and spending a lot more on necessities. So we took a pretty bold action and said, we're going to address that inventory. We're going to get our inventory levels right. We finished the year exactly where we wanted to be. And overall inventory down 3%, but importantly, discretionary inventory is down 13%. So as we go into 2023, we feel great about the inventory levels, the fact that we're going to be able to have the right new items in our assortment, but we'll lean into the categories where we're seeing the biggest growth, which is right now all those frequency categories, the food and beverage you need, your household essentials, and beauty. And we'll manage cautiously the other part of our portfolio.
Well, let's talk about the guidance, because I think people are wondering, are you being excessively cautious with the guidance that you're giving? For the first quarter, you're now talking about numbers of $1.50 to $1.90. The street was all the way up at $2.14. For the full year, adjusted EPS of $7.75 to $8.75, but the street was already at $9.23. Is that because so much of the strength is in lower margin businesses?
Well, I think we're being appropriate with our guidance in this environment. I mean, we know inflation is still high. It's been very stubborn. It's still at a very high level. We know interest rates are rising. And we're going to watch the consumer really carefully. But I think in an uncertain environment, we're taking the right steps to plan appropriately and taking the right approach to managing inventory and being cautious, and we'll react accordingly. Some of the things we're seeing, though, Becky, beyond just buying household essentials, we also recognize consumers today, they're looking for newness. So the actions we took with our inventory allows us to make sure we've got new relevant inventory in our system at all times, and we can bring that affordable joy that Target is so known for to our guests, even in this kind of environment. So you'll see a lot of new items in apparel and home, in seasonal categories, and we'll complement our strength right now in frequency and continue to make sure we're driving traffic by having the right items at the right price every time you shop.